Hi students. Today we're going to look at a topic that may be fairly new for you if you've just started your accounting education. And that is the accounting equation and a look at debits and credits. Basically the two names, debit and credit, of the double entry bookkeeping system that started pretty much as it is today in the early 1400s. So double entry accounting has been around for centuries, and now we have machines to do it. We have automated accounting software, but before you can use that, you need to learn some things. So we'll start with the accounting equation, and I would like to note that in your textbook or PowerPoint slides, you probably have a nicer looking diagram of the accounting equation. So for the nice picture and maybe the first look at it, you could go through the slides. I have just written it out here, and it is assets equal liabilities plus owner's equity. Now, owner's equity is a term we might use if a person has their own business, but it's not incorporated, so a proprietorship. If we were looking at a corporation, this would say shareholders' equity. But I'll stick with owner's equity for now because we're really just getting started in this course. So the concept here is that your assets have to equal your liabilities and your stake or your equity all the time. There's never a time in your accounting when assets don't equal liabilities plus owner's equity. So let's just take a really small example. Let's say that you have a house and a car and some money. So you have a house worth $500,000 and you have a car worth $50,000 and you have $50,000 in the bank. Okay, now this is pretty made up, so it didn't bother with the commas, but I can put them in. So here we have it. These are your assets: your cash, your vehicle, your house. Now you may have others, but this will be a quick example. So we have to say, do you owe any money on these? And we're going to say, yeah, I think you owe some money on your house. You owe $400,000 on your house, and maybe you owe $30,000 on your car. So these are liabilities, aren't they? And I think we all in our personal life recognize these as liabilities. So we might wonder, well, what is your equity or your net stake in all of these things? Or another way of looking at it, how much belongs to the bank and how much belongs to you? So all we have to do, I'm just going to type this out down here. We're going to take our $600,000 of assets, and that's the 5 and the car and the cash, and we're going to subtract the mortgage and the car loan. And I'm sure you can see where this is going already. If I take one from the other, I'm left with $170,000. So the $170,000 would be here. That would be your stake in or your equity in your own assets. So you owe other people money or other institutions money, and you own all these assets, and the difference of 170 is your net worth. And you've probably heard of net worth or personal equity or something like that. So what we have here is a mini example of the accounting equation at work. Your assets add up to 600,000. Your liabilities plus your own net worth or equity also add up to 600,000, and that has to always be equal. Now, In accounting, though, we're accounting for a business, and we have more going on than you would in your personal life. We have daily transactions. We might buy land and buildings and many vehicles and lots of things, and we, sell products or we provide services, and we have expenses. So we need a system to keep track of all those, and that's where double entry accounting comes in. So I'm just going to, get rid of this a little bit here for now, and we're going to take a quick look at debits and credits. Now again, there are lots of sources for you. I'm not thinking this one video is going to solve all your questions on debits and credits, but between, or among, I should say, the video and the PowerPoint slides and the textbook and the homework, you should be able to figure out debits and credits and get really adept at determining how to journalize transactions and so on. Before we start that, though, let's make sure we're on the same page. What are assets? Now, as you go on in accounting, or if you go on in accounting, you will find there's a slightly more sophisticated definition than the one I'm going to give you. But essentially, an asset is something that you either own or have a right to use that is probably going to give you a benefit in the future. So I've listed a few assets on the screen here, as you can see. Now let's think of you or a business. Cash is an asset, and I think we all agree that that will benefit you in the future. You can spend it and get things. Now, accounts receivable is interesting. This is money that other people owe you that they have to pay you back fairly soon. So if you lend your friend $100 and you know he's good for it, then his debt to you is an asset because he will pay you back, and that will provide a benefit to you in the future. If we're a business, we have things like merchandise inventory, things we buy to resell, or supplies that we use, for cleaning or stationery to do our work. So these we own, and they're probably going to benefit us in the future because they help us run our business. And then we have assets that last longer, such as furniture, vehicles, land, and building. So all of these are things you need to run your business. Now, land and building you may not own. Maybe you lease your land and building. But if you lease it long term, we still call that an asset, but there will be a corresponding liability or amount owed. But you are going to get the benefit of using the land and the building to help you run your business and therefore benefit you. So there's an asset, things we usually own, but sometimes we just have the right to use them, and they're going to probably provide a future benefit to us. So if you have a rusty old garbage can in the back lawn, that's probably not an asset because it can't hold anything because it's got rust and holes in it, and you might own it. It's your garbage can, but it's not an asset because it's probably not going to provide you a benefit in the future. You can't sell it for scrap metal, and you can't put anything in it. So just because you own something doesn't necessarily mean it's an asset. Now let's look at the next section, which is called liabilities. Now most of us in our personal life are pretty familiar with the concept of owing someone money. So that's just what a liability is. Now we have a slightly more involved way of defining it. We can say it's an amount that you owe someone else because of some decision you made in the past, and you almost certainly must pay. So let's take a car loan, for example. Lots of people get a car loan. So you decide to buy a car and you don't have all the money. So that's the transaction or the decision you made to owe someone. And you signed a piece of paper and it says, I owe, $30,000. So that's a liability to you. And you really don't have a choice. If you're going to be, legal or not lose your car to like a repossession, then you have to pay that car loan. So, legally you signed a paper saying, I will pay, I promise to pay. So you have to pay. Same thing for a building or land and building. Maybe you sign papers for a mortgage. So the transaction here is buying land and building, and you borrow money. So that creates a liability. And, it's very similar for a business. There's really no difference in a business. When they borrow money, they have to pay it back. So buying things on account, that's also a liability. So that gives us the last part of the accounting equation, owner's equity. And the nice thing about owner's equity is it's really easy to define because it's what we call in accounting a residual. And in English, that just means it's what's left. So if we take all our assets and we subtract all our liabilities, we have what's left. And that's the owner's stake or the owner's equity in the business. And just like we started with a short example of what you may have, maybe not today, but possibly in the future, you had owner's equity by subtracting all your assets minus all your liabilities. So that's not too bad, right? However, we have to keep track of this in business. And keeping track of it means we're using the double entry bookkeeping system. You might see it referred to as the double entry accounting system. Double entry means every time there is a transaction being something that does affect an asset, a liability, or an owner's equity account, we will have two or more accounts affected by that transaction. So we're going to write down the same amount of money 2 times. And of course, we have debits and we have credits. So when you start your accounting education, that's the tough one, right? We say, wow, I have to understand debits and credits. Well, yes, you do, because most of what you do in your accounting course is going to be using debits and credits. So you need to start with an understanding of what those are. So let's just start with what they're not. They're not anything magical. There's nothing that interesting about them. And in fact, the definition of a debit is simply an amount on the left-hand side of a 2-column accounting form. The definition of a credit is an entry on the right-hand side. So there we have, the classic phrase, debits on the left, credits on the right. You could probably go on the net and find the debit credit song. I know this is kind of corny, but if you Google the debit credit song, I think you'll get a kick out of it. They're basically singing debits on the left, credits on the right. Okay, so what that means then is that every time we have a transaction in accounting, there is at least one debit and at least one credit affected, and those two are equal. So debits remain equal to credits. And we have to look at how those work. So here's on this page, again, you could find a better picture of this in your book, and you'll see an alternate explanation in your textbook as well. This is just the video part to hopefully help you out. But this is an idea of how debits and credits work. So if we take an asset, we say all assets work the same way. So, if you understand how cash works for debits and credits, you can extend that knowledge to all assets because all assets work the same way. So assets have a balance, which we call debit. Again, a balance on the left side. And you'll notice I have assets here on the left and liabilities and equity here on the right. So assets have a debit balance, and when we have more of an asset or an increase, that's more debits. So we have an increase in the dollar value. However, if we have fewer assets, we're decreasing our assets, and we use what's called a credit entry to decrease our assets. So the thing you should probably note here is there is no such thing in accounting as a minus entry. In other words, let's say cash, we have $100 cash, and that $100 cash is an asset, so it has a debit balance. If we spend $40, it's not a minus debit for 40. Like, we know if we spend 40, we have 60 left, sure, but there's no such thing as a minus debit. Spending 40 cash is a credit because it decreases our cash. So I would take my 40, and that's a credit, and of course, we know that we had 100 and we spent 40, so we still have 60 left, and that 60 is the debit balance of cash. I didn't say what I spent it on. But let's look at liabilities and owner's equity. Now, they work the same way, except in reverse. Because remember, debits, all debits have to equal all credits. And we already know that all assets equal liabilities plus owner's equity. So if, just follow me here, if all assets are debits and assets equal liabilities plus owner's equity, then liabilities and owner's equity must therefore be credit balances, so that debits equal credits. So if we incur a liability, we write it on the credit side of our accounting equation, and it becomes a credit. So owing money is a credit balance. If we borrow more money or buy something on account, we increase our liability, so you also increase your liability with a credit. So notice that for assets, we had a debit balance and a debit increase. For liabilities, we have a credit balance and a credit increase. And if we pay off a liability, again, there's no such thing as a minus credit. If we pay off a liability, that is a debit to the liability, which reduces it. So you'll see here, debit is decrease for a liability. Now, owner's equity works the same way. Owner's equity has a credit balance. And if we have more owner's equity, that's an increase, so more credits and still a credit balance. If our owner's equity goes down, then that goes down with decrease. So let's look at just a couple of transactions to see how this can work for debits and credits. Let's say that you purchased a computer for cash. Now we could say, oh, look, a computer, that must be an asset. It's something I own, and it's going to probably benefit me in the future. So my computer is an asset. And let's look at what we gave up. We gave up cash, which is also an asset. So here's what's happening here. Our asset computer, we have more. Now you have, like, maybe you had a computer before, but you have more computers now. If you didn't have one before, now you have one. So computers have increased, and an increase to an asset is a debit. So I'm going to debit my computer, but my cash went down because I bought the computer for cash. So an asset going down is a decrease. Now notice in this transaction, liabilities and owner's equity were not affected at all. Only assets were affected. Every time you buy an asset for cash, you're going to increase the assets you bought with a debit and decrease cash with a credit. Now let's look at something really similar, except we're not going to pay cash for this computer. We found someone who will give it to us on credit so that we owe the money. So this time we bought a computer on account. So that would be accounts payable. And you know, from a business perspective or your personal life, if you buy something and don't pay for it, you owe the money. So let's say, again, we got a computer. We have a computer now. So my asset is a computer, and that is a debit because it increases an asset account. So my computer will be a debit entry. However, we owe money. And when we owe money, if we look over here, we can see that a credit is the balance of a liability account. It's also the increase side of a liability account. So the amount of money I owe is going up. So that's going to be, I'm going to call that accounts payable. You could call it loan payable or something. But basically, I have more of computers and I have more of debt. Notice that whether that computer was an $800 computer or a $2,000 computer, my assets went up with the debit and my liabilities went up with the credit, and that means debits equal credits, and that's always the case. Now, before we finish this video, let's look at one more example. And this is going to be an example where the actual owner of a business takes personal money and invests it into the business. So keep in mind that one of the main things we do in accounting is we keep our own personal finances separate from our business finances. So the owner might have money that he owns or she owns, and that owner is going to take that money and put it into the business bank account to help the business maybe buy some assets later or keep it running. So let's say the owner takes $10,000 of their own money and invests that $10,000 into the business by putting it into the business bank account. So we say, well, what did the business get? Well, the business got cash. Now, cash is an asset, and the business has more. Assets increase with the debit, so our cash, if we're going to do a journal entry for this or analyze the transaction, cash is a debit. Now, here's a neat little trick. If we have a debit now, we know the other half needs to be a credit because debits have to equal credits. If you started with a debit and you're pretty sure you're right, then the other one must be a credit. But let's look at why. The owner's equity is the equity in the business. The owner invested $10,000 of, let's say, his personal money into the business. So his owner's equity in the business went up $10,000. So owner's equity has a credit balance, and it also increases with a credit. So we have cash in the business going up with a debit, and we have owner's equity increasing with a credit. So far, so good. Okay, now, so that we don't have a video that goes a really long time, I want to give you some time to practice this a little bit and sort of get used to it with some of the exercises that that are assigned as homework in your course. And in the next video, we're going to look at what we call the expanded accounting equation and see how revenues and expenses fit into this in terms of debits and credits and owner's equity and the accounting equation. So that's for next time.